Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Greg Boland, CEO of Tiger Brokers New Zealand. Greg, it's great to have you with us. Welcome to Trade Talks.
Thank you very much, and welcome to New Zealand. Lovely to be with you.
Yes, maybe one day we'll be able to do this in person, either on site or at market site in New York. Let's talk about options trading. The activity hit record levels in 2021, powered by retail investors. Why is options trading attractive, and what are some of the risks?
Well, in terms of, you're right about the volumes. It was record volumes in 2021. Some 9.4 billion contracts were traded in the US, according to the Options Clearing Corporation, of which was a 34% increase on the year before. And even this year, though, a lot of people saying volumes are down, but volumes and options are actually up 6% year to date. In terms of options themselves, you've got calls and puts. They've been around for a long time. They started in 1973, so next year is the 50th anniversary of stock options and stock options trading. In terms of the advantages of them, the advantages tend to be they're very highly leveraged and therefore quite attractive compared to buying the underlying stock. You pay a small amount called a premium to buy a call or buy a put option, and this is highly leveraged compared to the underlying stock price. There's also room for high returns because of that leverage. There's a secondary market. The secondary market options create a secondary market for hedging and for trading in more speculative way. When you sell an option, particularly if you own the stock, and so you do a buy the stock and sell the option, you can create premium income for yourself, and that effectively lowers the cost of owning individual shares. And then also options provide necessary liquidity and price discovery in the underlying market. And options data, when we look at it, is quite a good leading indicator. You've got the VIX, which is the volatility index, the fair index, if you like, currently around 23, 24. Anything under 22, it starts to get a bit bullish, but it's been as high as 36 or 37 in the last few weeks. So it's been a volatile old time. Things like put-call ratios, how many puts are bought compared to how many calls. So it's their idea, one over the other. If a number is less than one, then it can be quite bullish for stocks. And a lot of platforms like our one Target Trade has got live put-call ratios. So investors should look at those and see what other people are thinking in terms of the market. There's also spikes in volatility as per the VIX, and when there's a lot of volatility, it's an important gauge of what may come about in the future. And of course, there's always advantages of things, but it's also a lot of risks. And obviously, the risk is a lot of retail investors are trading very short-dated options. They're buying calls for sort of 1 week expiry. This is fraught with danger, really, because they're really just ripping up their money. And there's been a lot of research showing that retail investors, probably lost $1.5 billion last year in terms of just buying short-dated options. They're not exercising them. They're using them for a very speculative way. There's for sellers of options, there's a risk of being assigned. In other words, that you'll have to deliver stock or take delivery of stock, and that can be, for seller, if they don't have the stock to buy or stock to sell, they have to go and buy it, and maybe at a high price. There's also, the risk of early exercise for the seller. They may have to actually deliver stock or take delivery of stock when they don't necessarily want to. They thought the option had a period of time to go, and that's not necessarily the case. So a lot of retail investors don't really understand these products, but they should learn a lot and learn a lot more before they just jump in. And in fact, retail investors are probably buying 70% of their options that they do are calls to 30% odd puts. So therefore, in a market like this where there's very volatile, the market is going up and down, you can make as much money on the downside by buying a put option as you can on the upside by buying a call. So, retail investors should look at that sort of product as a way of making money in the down market as well as the up market.
Right. And that's a good point. And Greg, we've been in a prolonged period of stock market volatility, and that's prompted some individual investors to abandon options trading. So what's the trend? What's your outlook if you look forward to the future of options trading?
Well, the volatility index, as I said, hit a high of 39. It's back down to around 24, 25. So, if you look at that idea of the VIX, then markets are starting to settle down. Although when you look at things like the S&P, it's down 14% year to date, and the Nasdaq's down around 23%. And then if you look at some of the darling stocks that a lot of retail traders trade, like Netflix and the likes of Tesla, well, Tesla's down 33% this year, and Netflix is down 67%. So, as I said before, you can make as much money on the downside as the upside, but I think the markets will settle over time. The S&P, for example, seems to be getting a floor here at around 4,100, 4,150. There's a resistance of around 4,300 on the top side. So the market hopefully will start to settle, and volatility as an indicator is coming down. So therefore, retail investors should be looking forward to when things may settle, and therefore get back into options.
Yeah. And to wrap up here, how can investors better leverage options?
Well, this new generation of people that are trading online and using apps like our Tiger Trade app, a lot of them don't really understand options. Young, tech savvy, and quite inexperienced. So in terms of the future, they should really learn a lot more about what they are. Don't just trade short dated calls or short dated puts. Look at longer dated options. A lot of them trading out of the money options, and they should start looking at trading in the money options. They've got a much higher probability of a win, if you like, and therefore they should start looking at that. Also, things that options investors, particularly young people, don't realise that the bid-ask spread on the open for the first half an hour in the options market is very wide. So don't just jump in at the open unless you're pretty certain that which way the stock is going to move. And also be wary of the spread can be as much as 12% or 20%, that sort of range for some of these short dated options. So you're actually giving away 12 to 20% of your upside when you first enter the option. So be careful, and don't just automatically cross the spread when you're buying options. So those are sort of some of the things that retail investors should look at in terms of options and how to trade them.
All right, Greg, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.